which changes over a period of time. I described monetary policy 1, interest rates. Monetary policy 2, buy financial assets, print money and buy financial assets. Monetary policy 3, which we are in, is the printing of a lot of financial assets by the central bank and then buying government bonds to finance the deficit and getting money in the hands of those who wouldn't have had it through the normal financial system, essentially through that coordination. In all history, so when we go back to the 1800s and so on, there is that. And so the alleviation will happen in terms of that kind of ease. So when we think interest rates are going to hit zero and that therefore depressions last, no, they don't last. Because in one form or another, and we're seeing it here today, that they will be the printing of money. Now, the value of money may not last, or they could be depreciated. But in the end, they always will ease, and you will have then that kind of reflation movement and that kind of change. So the hitting of a zero interest rate is not a hitting of a floor on the capacity of central banks to ease. It has to be manifest in one of three things happening. If you look at the history, you've seen it happen time and time again in the same way, and it lends itself to three types of assets responding. The that's happened in March 5th, 1933. Roosevelt makes the announcement about severing the dollar from gold and depreciating it and reflating it to give the banks the money that they have to pay their depositors. The same thing happened August 15th, 1971, when Nixon got on television and said that he is severing the relationship with gold and printing money and so on. The same thing happened in November 2012 with Mario Draghi making the same kind of moves. And the same thing happened on April 9th when we had the moves by the U.S. Federal Reserve and the U.S. Congress and Treasury. Same type of movements happened in 2008 when the Treasury put together and the administration and the Congress put together the TARP program and they went to quantitative easing. Those are the things that you always see happening, including times that I haven't mentioned. And when they happen, that is what happens at the equivalent of zero interest rates, okay? It is that kind of movement and that form of easing, and that's what we're seeing. And so easing doesn't end, and the liquidity squeeze and the debt squeeze is dealt with, but it's dealt with through the printing of money that could become manifest in either the real interest rates going down, which in the case of with you have a low level of inflation and zero interest rate must be manifest with an inflation rate rising, which eventually happens, doesn't usually happen at first, or there's the depreciation in relationship to other assets. So what you're seeing right now is that reflation becoming manifest in the money that is being purchased by the Federal Reserve and government, then going into assets that are equity assets into credit assets and so on. And that's the manifestation. Or you could see it in gold, or you could see it in the depreciation. One doesn't necessarily know at the time which is going to happen. So in 1971, when that happened, there was a big decline in real stock prices because inflation accelerated. But you do know that that combination of reflation assets will happen in a way that's very similar to the cutting of interest rates when they hit zero. I really believe that in this environment, most investors will think safe is cash, and that's tragic. So you can see that one has to think differently from one's habits. When one thinks cash is not a safe investment, it's a risky investment, that stocks and bonds are not the same as they were in the past. One has to think of the storehold of wealth concept rather than just equity returns. One has to think about balancing differently. All of these things that I'm bringing up are not commonly thought about. They're not part of the common experience of investing over the past many years. In order to understand the lessons of history and even what's more likely to take place, one has got to go back to periods that were analogous to this and to study those periods. And when we did that, over the last 500 years, you could see that you don't know if you're going to see the depreciation of the value of money and the storehold of wealth. So all of a sudden that changes what you define as risk. You used to think cash as a riskless asset. Cash can be the most risky asset as it depreciates in value. And then you start to think about different asset classes and different locations. So that's what we're doing. When we think of what is the diversified portfolio for an easing that happens at that time, that's kind of a reflation portfolio. And how do you measure that in relationship to other things? Because I think the one thing that we could be confident is that the Federal Reserve and other central banks are not going to let an implosion happen without printing a lot of money. We know where interest rates are. You know that if you take a 10-year bond, you know what your return is going to be on that 10-year bond. And if you then do calculations of what is the expected returns of other asset classes, start off as you deal with each of those companies that are borrowing, and you look at what their interest rate is, and then you look at their equity expected return relative to their interest rate based on the present value of the discounted cash flows, that all asset classes, and that includes private equity, it includes venture capital and so on, have very low expected returns, meaning that if you were to just hold them over the next 10 years, they're all going to have not nearly enough return, and they're going to be low. So that's a fact of life. We also know that asset classes are affected by monetary policy. So when they lowered the interest rates and did a number of other things in the past, that allowed asset prices to rise. We know a number of those things won't be able to happen in the future. So if we start to take a picture of that, we know that, in fact, you can go to maybe negative returns. And it's all happening because it needs to happen from an economic point of view. It needs to happen because there's a lot of debt and a lot of liabilities, pension liabilities, healthcare liabilities, insurance company liabilities, and so on, that are coming at us that can't be funded. So they need more returns. And so we've been in an environment where there's been a leveraging up of those returns. So because all that liquidity has been put in by the central bank because it needed to be stimulative in a no interest rate environment, we have all that liquidity looking through all the nooks and crannies of all asset classes, driving their prices up relative to their expected returns, and therefore their expected returns are going to be low. Okay, so that's a reality. Then we know that we're going to have volatility around that. You have volatility caused by the sorts of things that we've seen. Some of those things, if you have a downturn in the economy, it has economic implications. And then you have a new world in monetary policy. That new world in monetary policy means that no longer is there the allocation of capital in the ways that we were used to it. In the old days, though what would happen, this capitalist system, is central banks would put on deposit cash, and then bankers would come along and think about borrowing that cash and lending it to institutions or people that will pay back and that they'll make a positive spread on, and the free market made the allocation of those capital. Much less so today. Today, the markets are driven by central bankers and central governments deciding that they're going to put money in. So, and how they do that and the reactions are producing and will continue to produce volatility. It's very much like the war years, but that allocation of capital and how that is operating will create volatility. We see volatility, and so you have to deal with that volatility. But that is the character of the environment, so that the environment, it's a reality, right? Does anybody disagree that the returns of asset classes will be low from just an expected return point of view, and that monetary policy, and which is now buy financial assets and so on and print money, will be a lever that's going to have an effect on that. And so we're going to get volatility, and we have a high amount of uncertainty in that environment. So that has implications. If we agree on that, that's a fact of life, right? Can we agree on that we're going to have low returns, inadequate returns generally relative to needs with a lot of volatility around them? Can we agree that's a fact of life? I think it is. And then the question is, how do you approach it from an investment point of view? Let me describe it this way. Achieving balance, which means diversification, is more important than ever, though it will have a lower return than before. So do you want an asset class return, or do you want a portfolio of well-balanced assets? So when I look at that, I'm saying, let's say if you take a 60-40 stock bond mix, or if you take equities, or you take any one of those things, no. I think the most important thing is to start with diversifying well. Diversification of asset classes, diversification of countries, diversification of currencies, diversification, because I think that the one thing we know is that we don't know a lot, and it's not easy to necessarily time it about what is going to happen, right? So we should be given humility, and because the markets are relatively efficient in making those comparisons, it's not like one thing is necessarily better than the other, as much as we do know that some things are better diversifiers than other things to produce whatever that excess return is, that it is as stable as possible and least risky as possible to try to achieve balance. So as we look forward, what we can say is the excess returns will be lower, the premiums are a bit lower, but it still is better to have that diversified portfolio. It'll be a lower excess return, but it still means more stable because the individual items that make up will all have low returns, but the combination of them will make it more stable. The concentration in any one asset class, in any one country, in any one anything, history has shown is dangerous, and it is dangerous now. So when I look at it, for example, what we're seeing is reflation. We're seeing the central banks printing money and buying assets. And I do believe that they're going to continue to do that. Then the question is, does that become manifest in a way where it drives stock prices up? Does it drive the value of money down? Does it drive gold prices up? So what I've done just over the last maybe year and a half was to go back through all history. You know, you're aware of the 500-year study of all of these particular cases, and to see literally what that set of choices is in all of that range of choices. What you will get is easiness, but the lessons of what will happen largely existed prior to 1945 when we began our monetary system. What I mean is that we've been living in an environment of ideal conditions, which began in 1945 with the formation of the new monetary system and the dollar-based monetary system and the restructuring. And that's been a great, great environment. And we have learned certain habits from that environment. For most investors, you have to think about real returns, but not for all investors, because in some cases they've incurred a fixed liability. In any case, I think the big thing is that almost no investors has enough money relative to their needs. It may affect the time horizon, but if you looked at the richest investors, generally speaking, and you looked at what are their revenues, what are their expenses, and what is their saving. Every individual, every company, every country has to go through that exercise. And when you look at that exercise, can you spend on your liabilities or pay out that amount of money based on the income that's coming in or the way you're going to have to tap that savings pool? You can see all around you those that are going to not be able to make it, not be able to come close in the period that we have. You have to think, what does that mean? That is going to mean that those will not default. You cannot tell most of the people that they won't get their money. That is going to mean that a lot of money is going to have to be printed because the obligation is to print that amount of money to fill those liabilities. And so that's the situation that we and most of the world are in. When I think of investing, I want to invest in the competitive countries. I want a multi-country investment. I want a multi-asset investment. I want multi-currency investment, and I want a storehold of wealth, because what happens is wealth is not so much destroyed as shifted, from one asset class to another. There's competition of asset classes, competition of countries, competition of currencies, and so on, and they move around. And so they have to start off diversifying well, and then they go to where are the alpha sources, and how does one create a well-diversified mix of alpha sources? So it's the same old story. The cycle that I saw was brought about by seeing three important forces that I hadn't seen in my lifetime before, but happened many times in history, which is why I needed to study that cycle over the last 500 years. First, when governments run out of money, they need more money than they can get. They print a lot of money, and it debases that money. We have had the largest debt increases and money creations, particularly in the leading world's reserve currency, the dollar, although that's been true in the euro and it's been true in the yen too. And that has a big effect. The second of those influences is really a political and social influence, which is the conflict between the left and the right, populism, often typically due to large wealth gaps and opportunity gaps, which exist in the United States now. And so you're seeing a conflict, you're seeing almost a civil war, because as you have populism consists of representatives who will fight rather than compromise, fight for their way of doing things. And so we have an ideological and economic differences that are also political differences that you could see every day reflected in the news. And you saw that the issue of losing. I think we're in a situation where we can have an election in which neither side accepts losing. And so we see that reflected all the time, such as the Supreme Court ruling on abortion. You see that type of conflict. That conflict, the measures, I like to measure things, is the greatest since 1900. And that also relates to the economic one I touched. And then the third, as far as the changing world order, is the relative decline of the United States and rise of China and other countries. India, for example, of course, has improved its position, many countries. So that when the New World Order began in 1945, world orders come after a war, and then the victors in that war determine how things should go. In 1945, when the United States won the war, it was the richest country in the world. It had 80% of the world's gold, and gold was money. And it had half the world economy, half of world GDP. And it had a monopoly on the military power. It was the dominant world power. And that's why we have the United Nations in New York, the IMF and the World Bank in Washington, D.C. And that relative positioning, there's been a decline in that relative positioning and the emergence, particularly of China, as a great power. And so there is a great power competition taking place. And traditionally, through history, that is resolved by conflicts. So we have 5 different kinds of wars that happen, and we're seeing them now: a trade war, a technology war, a geopolitical influence war, a capital war, and a military war possibilities. So that confluence produces these difficult periods. The last one was 1930 to 1945, and that's what we're in the midst of. So it's very important for me as a global macro investor to understand those, and that's why I did this study. It affects my positioning today. The most important thing is to not own debt assets which are subject to inflationary pressures. If you're buying an inflation indexed asset, that would be fine. They're inflation index bonds, but to not own assets which will lose their buying power because there's a lot of debt and has to be printed. The second is to create a diversified portfolio of assets, a well-balanced. If you diversify well and you look at the correlations between asset classes, you'll see that one thing goes up, another thing goes down. For example, during times of greater inflation, you see commodity prices, gold, real estate prices, you see those types of assets perform better at the expense of other assets. And also the stock market has parts of the stock market, these different stock markets, which are not primarily going to be hurt by investments. There's many that benefit by inflation. So to create a diversified portfolio, diversification is of paramount importance because it is the way that you can maintain a good return without as much risk. In other words, if you pick investments that have about the same expected return, but they're not correlated, and you put them together well, you can reduce up to 80% of your risk without reducing your return. So how to create good diversification is very important. That includes country diversification. All the currencies are now fiat currencies. The dollar, of course, is the leading world's reserve currency. They are related to each other. No country wants, in this environment of relative depression or relative lower prosperity, no country wants to see its currency go up too much. So the fiat currencies, this tends to be a fair amount of printing money and then a lowering of that. We are in a temporary period that I would say will probably last 6 to 12 months of a tightening in monetary policy, but that will be the correction in the trend. That tightness will produce weakness in markets to be followed by weakness in the economy to be followed by another round of easing. So I want to be clear, the printing of money and the large debt will have a correction as there is this tightening coming up, which will be probably over the next 6 to 12 months. You'll have that. So as a storehold of wealth, they won't bring interest rates during that tightening to a level that will compensate for inflation. So you'll still lose money to inflation, which it means it's still better off in those inflation hedge assets. So when we look at the currencies, we're used to looking at them in relationship to each other, but they all have that issue. Then there are non-currency, non-fiat. Gold is an example of a non-fiat currency. And then, of course, we have digital currencies, which are newly developed, and that's a non-fiat currency. I think we've entered a period of time over the next several years where the world is going to be looking for what is an acceptable currency, and it's going to be confusing. And so these currencies will compete with each other. There'll be less attention to fiat currencies and more attention than to others, but still, of course, the dollar will be important. And then you will see the renminbi become a much more important currency. Gold, let me tell you about gold as a generalization. Gold has a return, normally it's low returning. It is a dead asset. It is a beautiful, limited supply, dead asset that is money, unlike, let's say, equities, in which there's constant invention and productivity. But it's very important to own at some times, and at other times, it's just going to be a dead asset. And those times are these times of a lot of debt and money creation, and times of conflict, times of wars. In wars, even allied countries don't want to lend to the other country because everybody's getting in debt, and so they'll be paid back with a depreciated currency if they win the war. So I believe that this environment that we're in is an environment which is good for gold, and therefore it should be a significant part of the portfolio, but not a dominant part of the portfolio. What that might mean is maybe 15% of the portfolio. That would be, quite a large allocation. Under today's circumstances, perhaps, as much as that. And then there should be other assets that diversify the portfolio. Cryptocurrency's been really amazing in that, let's take Bitcoin. And there are two types of cryptocurrencies, I'm sure, in which the quantity is contained, as distinct from other types of coins in which there's a variability, such as stable coins or Ethereum. But anyway, amazing that they were programmed and have operated for, I think it's 11 years now, haven't been hacked and so on, and have been acquired. Still, there are issues with them. The total value of Bitcoin, for example, all that money, is less than the value of Microsoft. And so when you think of different storeholds of wealth, it's not very big. By the way, the gold market isn't very big either. It's about 5 times the size if you take out central bank reserves and jewelry. So they have issues. Transactions can be traced, so the privacy issue is an issue. So they can't be controlled. They can be shut down. They can be made illegal, which tends to happen during times when they may be threats to the alternative currency. I don't think they'll be held as central bank reserves for various reasons. There's a saying that gold is the only asset you can own that isn't somebody else's liability. In other words, you own it and you don't have to wait for a payment from somebody else. And I think that as the environment that we're in, there is a risk of political confiscation or other forms of confiscation. Gold does, a better job. But as I say, we're into this new environment. Is it something that you can carry with you and that you can transact almost anywhere in the world because somebody will buy it? It's equally acceptable in most places, ideally private. If you can find those things, it's a competitor, but I think in terms of its qualities, not as good a competitor. One of the most important indicators is the cost of an intelligent person, a cost of an educated person. That's a very good leading indicator. India stacks up very well in that regard. And its levels of indebtedness, which is another important indicator, is in comparison to other countries relatively good. These are two important indicators. The general level of education and infrastructure and internal conflict and so on are areas of greater concern. And so is the element of the bureaucracy. It's a country that probably will have the highest growth rate over the next 10 years. We project it to have the highest growth rate of any country over the next 10 years because of the advantages of that, those things that I mentioned. And then to the extent that there is improvements in those, which it looks like there are improvements underway, then India's outlook looks very good.
The item that's going to be given the most attention near term, the deficit, or I should say deficits. What we have are big deficits and big debt. That debt problem is an American budget problem, government debt problem. It's a European problem. It's a Chinese problem. It's a Japanese problem. And in order to, again, explain how this works and what needs to be done, I put out my piece and the book that I'm writing. I'm putting it out as a draft and I'm making it free for everybody, How Countries Go Broke, because one has to understand the mechanics of that. Here's the thing to keep in mind. 3%, keep this in mind, 3%. We will have a deficit, a projected deficit, if no changes are made, that are going to be about 7.5% of GDP if there's a continuation of the tax cuts. That number's got to go down to 3% to keep it the same. If we don't have that, we are likely to have a big supply-demand imbalance, which will take the form of the selling of more bonds than can be bought by the private sector, and a big problem. You know the problem, of course, when we had COVID. What happened is there was a big deficit. They wanted to send out checks, and the central bank printed money and bought the debt, and we experienced a big inflation.